Hello, everyone. Today is a different one. It's an interview with a top-class CEO, and not only that, but we will do it in English, unless he's surprisingly telling us that he speaks perfect Spanish, but I'm not expecting that. So, well, we have with us Brett Kelly. He is the CEO, the chairman, and the biggest shareholder of Kelly Partners. How are you doing, Brett?
Fantastic, gentlemen. How are you?
I'm doing great, actually. We also have with us Gerard, that he has been, he's part of the compounders team, if we can call it that way, and is the person that probably knows better Kelly Partners that I know. So, uh, welcome to have you here, Gerard.
Hello, nice to see you again, Brett and Capi, of course. Very happy to be here today.
Yeah, and the thing is, like, we had the opportunity. I think it was like 1 month ago, Brett, or 1.5 or so, that Brett came to Barcelona, and we had a meeting there, and it was very, very interesting for me. It was very insightful, and then based on that, and based on the conversations that we had with him, he kindly accepted to have this interview with us. So first of all, I'm telling you this in advance. I don't know how it's gonna go, the interview, but thank you very much for your time.
No problem at all.
Perfect. So first question straight away: who is Brett Kelly?
Well, I'm just somebody that likes to make things better. So as you get older, I'm 49 this year. I started in accounting at 18. When I was about 15, my father's company was damaged by an accountant who embezzled money. There's that saying that the story of the father's embedded in the son, and that's certainly true in my case. I was going to go and study law and go into business, but then I realized how important accounting is. So I went to Pricewaterhouse, took an undergraduate cadetship, and worked in chartered accounting firms. I spent 4.5 years at Pricewaterhouse, went to Schroders in investment banking. I lost my job. The next youngest person employed there was 10 years older than me. And they said that, I was different and that I didn't fit in with those people. At the time, that was very difficult. But as I, got older, I felt that I didn't fit in with those people. They were very transactional. They weren't investors. I have a joke that in investment banking, the only thing you can't find is a banker that invests because they're so short-term and transactional. I'd been reading everything about Philip Fisher, which led me to Warren Buffett or Ben Graham, Warren Buffett, Charlie Munger, since I was about 17. And I was really fascinated with business. I went back into accounting. Well, after I lost my job, I worked in a software company called ValueAdd that built the first software to assist you to do an EVA, an economic value added valuation. I'd worked in the EVA team at Pricewaterhouse, and that taught me sort of through Alfred Rappaport's book, Creating Shareholder Value, that when you invest, you want to get a return above the weighted average cost of capital. And so with that sort of insight, I then, after I'd lost this job, I wrote to 80 prominent Australians. I asked them to spend time with me in an interview. I interviewed 34 of them, 5,500 phone calls in 3 months. I turned that into a best-selling book that I self-published. I raised the money to self-publish that book. I did 200 professional speaking engagements off the back of that. And I went back into accounting. But when I went back into accounting, with a skill set that other accountants don't have. So I had the ability to come up with an idea, which was a book, to facilitate the book, to build the team. So I needed an editor, a proofreader, a typesetter, a graphic designer, a distributor, and a PR person, public relations person. And then I had to risk my own capital, raise my capital, use my capital, then raise some capital to put the book into the market. And then I had to sell the book. And so once I had done that, I really came back to accounting with a very different skill set to that which most accountants have. And then I'm looking at at the accounting firm I joined, and I thought, why are these firms such good businesses but so badly operated?
Right.
And, I learned later that my great passion in life is learning. But as I was looking, at these businesses, I thought, everyone's unhappy. They don't make that much money. So what are they doing? Anyway, I went through 3 accounting firms where they promised to do one thing and did something else. I learned that the young partners don't really look after the older partners, that succession was going to be a huge issue. As part of my master's degree in taxation at that time, I studied Australia's first intergenerational report. We wrote the federal government published a report on the intergenerational challenges facing Australia as the population aged, and I realised that succession in private businesses was going to be a huge issue. This was in about 2003, 4, 5, in that area. I started the firm Kelly Partners with my wife Rebecca in 2006, June 2006. And interesting, Capi.
One question, sorry to interrupt, but that part of the succession that you identified, right? And I guess that you link that with, there will be some business, some accounting business that there will have people that is becoming old, and there will be a point where these people is too old to continue with the business. I guess that you saw an opportunity there. That's correct?
Yeah, I saw 2 things. So I realized that Warren Buffett made all of his money buying private businesses.
Right.
I realized from Charlie Munger, Warren had said to Charlie, don't be an accountant charging hourly rates. Don't be a lawyer charging hourly rates. I thought, don't be an accountant charging hourly rates. He said, Charlie, you've got to be an investor. I said, okay. And then the third thing was that I knew all the baby boomers owned the firms and that they would all retire and there'd be this huge intergenerational transfer of wealth. So I said, right, I need to be an investor, not an hourly rate accountant.
Yeah.
I need to understand that there's going to be this huge transfer of these businesses and someone has to buy them. And I said the best way to do that would be to build a holding company structure like Berkshire. From day one, I just wanted to build the Berkshire Hathaway of the accounting industry. So to have a holding company that would buy, a portfolio of accounting firms. So when I would go to the Berkshire meeting, you would see all of these disparate businesses that Warren had bought, a boot company, cowboy boots. He bought a boat company, a jet company, a shoe company, this company, an insurance company. And I said, okay, imagine if you had a big trade fair like that, a big room, but they were just all accounting firms. The reason I did that was because I took to heart this idea of circle of competence. I said I had a tiny circle of competence, and that was accounting firms. I didn't know anything about buying a shoe company. I didn't know anything about an insurance company or net jets. I love jets, but I don't know how they work. I'm not a physicist. I'm not like Elon can explain how a jet works, but I knew a lot about an accounting firm.
But
so I said, find a circle of competence. So it's like Charlie Munger, become an investor, not an accountant. Have a holding company like Warren Buffett, stay in your circle of competence, just accounting firms. And then my view was that those assets were undervalued and I could do this over and over and over again. The other very big influence was Sam Walton, Made in America. So he said, go to places that are small where no one else wants to go and get big before anyone notices. So we were doing, I love McDonald's and I loved Walton's, like Walmart. And I said, I'm going to go into the growth areas where no one else will go, and I'll keep buying firms while no one else is looking, just very subterranean. And I'll quietly build size on one brand, one IT network, one system of doing the work with a unique client experience. And that if we compound it, and this is very important, Capi, I had read the book Built to Last, Jim Collins' book, and it's built 100-year business. And so then I said, if we want to build a 100-year business, if we compound at 20% a year plus, we've compounded at 30% a year for 18 years in a row. But I was like, if you grow 20% a year for 100 years, you'd be quite a good company. And so from day one, it was like, how do we build a top 10 accounting firm in Australia? So we have to have the people, the systems, and the processes to build a foundation that could scale. And so they're my heroes. Basically Charlie Munger, be it, don't be a lawyer, be an investor. Buffett, do it in a holdco. Stay in your circle of competence. And then
Right.
Sam Walton, Sam Walton and Ray Kroc. Ray Kroc built a customer proposition, a brand, and Sam Walton had the best back-end operations in the industry. So we came to a very unique model of 5149 model that...
We will speak later about that. But one thing that you said that it sounded really interesting to me is that you said like build, grow, and grow. It was kind of grow as much as you can while you are getting unnoticed, right? Are you
Correct.
still unnoticed, Kelly Partners, or no?
Capi, most people live their life with their head up their ass.
So what do you want to tell me to answer my question?
When we went public 7 years ago, everyone said, don't go public because everyone will know everything about you.
Right.
Still, basically, no one knows anything about us.
Okay.
Because when your head's up your own ass, all you can see is your own shit. So most people, they're not looking out trying to learn. They don't read, they don't study, they don't travel, they don't visit. They're basically all the time, looking at themselves.
Okay.
And we are still very invisible to the industry. Most people don't know us, know anything about us. That's fine by me. I don't mind. It's not my job to sort of educate our competitors.
Right.
And still, even if they knew everything about us, if you combine activities in a unique way, this is Michael Porter, build a critical activity network, very hard to duplicate, and really excellent, leadership management and operational excellence is almost impossible to duplicate. So we continue to go places that other people don't go. The addressable market is so large that there's plenty of room for us to continue to grow forever. And so we're not too worried about that. Our move to America is the same thing. I'm here, no one knows me, no one knows what we're doing. We're just quietly, it's just the same playbook. We're just quietly, subterraneously looking around the market and doing what we do. And it won't seem like we're doing anything because compounding is very hard to see. If you look at a point in time, you can't see the compounding. You can just see today's number. You've got to have...
It seems like it's moving slowly, but it's moving all the time, right?
Correct. And that's the thing that most people miss investing, is that they're looking at a point in time, and most people are not capable of being patient, having the mentality to be patient. And they won't look across 20 years. And most of the compounding, if you run a set of numbers, the compounding happens between sort of year 12 and 20,
Yeah.
And most people can only concentrate for 20 seconds.
That's true. Okay, so I take it that it will last still for some time, that you are getting unnoticed and you can continue working on that kind of compounding that you are doing in Kelly Partners. Okay, so one thing that I would like to know is like, how is a typical day for you?
So I get up
before a bit, before we started to record, so we can go from there, I guess.
Yeah, so a typical day, now that I'm living in Los Angeles, I will typically get up around 6 o'clock and I will try and have a workout and then take the kids to school. If I can't get a workout in before I take the kids to school, that will be because I'll come into my study here and do some work while the kids getting ready. And then I will then make sure the kids are off to school, and then I'll have a workout. My day on Australian work starts at about 3 o'clock in the afternoon. I work till 7. I have dinner, and then I normally work from 9 till 11. I'm now trying to start at 2 and stop at 7, so I don't work all night, because for the last 18 months, we've really been a startup. So I've really worked till midnight every night, started at about 6 in the morning. And so I'm trying to stop that. During the day here in Los Angeles, I've got time in the morning to speak to our teams of our businesses here, to work on those businesses and to prospect for new businesses. So I do phone calls and meetings I'll drive around and meet firms or speak to them on Teams. We've met over 100 firms so far in the US, and conducted sort of meetings in our sort of process. That's very important because it allows us to sort of get our eye in to sort of understand the market. Every conversation is valuable because you learn something from everyone.
Right.
It's easy for me to attend conferences from here, which I've been doing for a number of years, and just meet the major players and observe the market and understand the culture. So that's sort of my day. I have lunch at 1 o'clock every day. I'm very, very structured. My calendar, year looks like this. It's extremely structured, calculated, and sorted out, so that I can really just think about what I'm trying to do.
What about the weekends?
The weekends, well, just on that, like I carry, and I think this is helpful for your people. I carry a little card like this in my wallet, and that has my goals on it, and it has the things a CEO should do, and then it has our 3-year plan in the middle of it, and I keep this in my wallet, and it's stuck to my steering wheel, so that I don't forget the things that I meant to do. And then what that is, that's basically, that then gets translated, that comes off this calendar. And the sort of master documents, this thing called a vivid vision, which is a 3-year plan across our 12 parts of our business, how we intend to grow the business. So, supporting that's a big spreadsheet. And so I've got these sort of physical tools that just sit with me. A lot of people are all digital, which is good, but it means that I can have these physical reminders around me all of the time, which is great because often I'm doing this and I don't want to go into another screen. So by super planning, I could show you my day on my calendar. It's very, very, very structured. So by really planning enormously in December, I plan in December for the next 12 months, and really now for 2 years ahead, I can then be very relaxed in terms of what I'm trying to do. On the weekends, really Saturday, I spend with the kids. So I sort of try to work out what they need to do. And then I have a workout. I try to walk 7,500 to 10,000 steps every day in the morning. So that's normally get up at 6, do my steps, go for a walk before everyone gets up, make sure everyone gets up, come back, take them to school, and then do my work, have lunch at 1 o'clock and do my Australian work in the afternoon.
Yeah.
On Saturday, I do a version of that. I get up, I go walking, and then I go and do a workout. Normally my kids, my 2 elder sons, I've got a 19-year-old, 16-year-old son and a 12-year-old daughter. My boys like to go to the gym, so I'll try and go and have a workout with them, which is fun. They're big into lifting weights, and both of them are quite big and fit, which is good. Keeps me healthy. And it's down by the beach, which is good. And then in the afternoon, what I try to do is I try to sit over there in my chair. My favorite piece of infrastructure is my chair, which is over there.
Okay.
And I go and I sit there and I read. What I like to do the most is read. And so I sit over there and read. I also have a TV so I can watch documentaries, which is just there. And so really, this is where you'll find me. My happiest place is my study. Whenever we bought a house, I buy a house based on the quality of its study. I've got a really nice view here with good light, so I can work. I have another desk just here, which I just use for writing. And I have a big table behind me, which is full of books. So Saturday afternoon, I try to do that. Unless they want to go somewhere, if my kids want to go somewhere, I'll take them somewhere. And then Saturday night, we'll typically do something together as a family. Sunday, I go to church in the morning, and then I take the kids out to see an art gallery or a shop or something they want to see. I find that the kids are great because they keep me in touch with popular culture. So, hey, Dad, I want to see this shop. I want to see this museum. I want to see this art show. So I try to do that on Sunday afternoons. And then on Sundays, I want to be finished that by 3 o'clock so I can sit over there and read. Okay. And then family dinner on Sunday, 6 o'clock, 6:30, quite early so that I can just have a clear space for the week. On Sunday now, it's Monday in Australia. So on Sunday afternoon around 6:37 after dinner, I'll sit down and maybe do an hour of Teams calls if something is very important in Australia, and but then I want to get to sleep and ideally watch a movie, or the tennis and French Open's on at the moment, so watch the tennis with my wife, and then go to bed.
Are you watching Roland Garros now or no?
Yeah, I was really sad. I saw Rafael lose last night. Today. That was sad. I met him in Melbourne many years ago. He's a great hero of mine. So that's by being very structured, by having a clear 3-year plan, dropping that down into what you need to do each month, each quarter. So each quarter, each month, each day, putting that in your diary. I then have, Warren Buffett talks about having an empty diary. In my mind, once I'm very organized, I feel like I really have complete control over whatever I need to do.
Right. Okay. And just to close this part, how is life in the US? Like, are you missing Australia? Is what you expected?
Yeah. So I think that, I had a really beautiful time in Barcelona with you guys and a bunch of other great people. I had a great time recently. I was in Texas, then I was in Tampa in Florida, and then I was in Miami, where I met a great friend of mine who's doing amazing things in business. So what I find is that anywhere I go, I was in Sweden earlier this year for the Serial Acquirers Conference. So I have this great privilege in life of just spending time with really great people. And so if I'm with good people, I'm very happy. I'm happy in Sydney, in Melbourne, in Perth, in London, in really anywhere. The quality of my experience of a place is really the quality of the people I'm spending time with. So I'm happy if I'm doing that. What's great here is that I've been able to spend time. I spent 2.5 days last year in April with Jim Collins in Boulder. He did a session for people that he thinks can grow great global businesses. That was incredible. There was 10 of us. He said to me, Brett, the seat you're sitting in, Warren Buffett sat in for 10 years. Incredible. I couldn't have done that if I was in Australia. It would have felt too big. It would have been too much time away from my family. My wife wouldn't have been that pleased about that. Here, I've been able to get closer to people that are really helping me grow. And I always say that a business can't grow bigger nor faster and be sustainable than the growth of the leader and the leadership. You've got to grow your leaders to grow your business. And so, we had 80 people at the Berkshire catch-up that we just did at the Berkshire Hathaway meeting. We had a shareholders catch-up. If I wasn't living here, I wouldn't have organized that for the last couple of years.
Right.
It's expanding me and my understanding and sort of insight into life and business, and that's helping grow our business. The other thing it's done is it's really energized our organization. Our senior leaders, our partners, are very excited about what we're building, and if you can add energy and excitement to people, they will grow the business with us. So I like it here a lot. I don't, just because I'm spending time with great people doing things that I'm really interested in. It's a bit surreal. It's very much like Sydney. It's very sunny. The people are very open. It's just that the market's 15 times bigger, which for someone like me is pretty exciting. I get excited about that. Not everyone gets excited about those things, but for business,
well, sounds very good. I'm sure that you're sharing a lot of energy with us, because even we are on an online meeting, you are sharing a lot of energy, etc. So happy to speak with you, Brett, of course. And well, going forward to the next part of this interview, I'm sure that you know that Momentum Financial, we are paying high attention with some compounders with this kind of investment philosophy. So we have mentioning many companies such as Technion, Judge Scientific, Constellation Software. So today we are lucky to have one of the top class CEOs and biggest shareholders, of course, representing what is a compounder. So the following questions would be more about this kind of philosophy, not specifically from Kelly Partners, which would be the next one. So my idea is to have an understanding of what you know, or what you believe about what is a compounder. What is a company that is named a compounder or a serial acquirer from your perspective?
Yeah, it's a great question, Jared. We think of a compounder as something that intrinsically has a series of values and behaviors that allow that business to continually grow. And it's very much a reflection of the flywheel of that business. So that's how I think about a compounder. What you're compounding is first values and then behaviors. So that's mission. And then you've got to have the fuel, the financial fuel to get across the bottom. So Jim Collins talks about his flywheel, mission, and across the bottom fuel. And so for us, the question is, does the business system have this ability to continually fuel its mission and grow at a compounding rate? Now, for me, I want to compound it up at very much higher than the cost of capital. So it's very important to me that firstly, you've got mission, values, and vision that push over the top of your flywheel, and then around the bottom, you've got financial returns that are above the weighted average cost of capital, so that you can continually fuel this flywheel forever. So they're the two things that in my mind I've put together. You can't get that return above the weighted average cost of capital if you don't have a business system. So you have to have a business system that actually drives this flywheel.
Very good answer, because here we tend to analyze companies, to analyze metrics, KPIs, etc. And maybe we don't, of course, we look for the values of the companies, but maybe we are not paying so much attention to these factors, to the values of the companies, that of course it's a very interesting idea that you are considering a strategic pillar on every compounder.
Yeah, so Jared, this is Maslow's hierarchy of needs. And this is how a person develops to being somebody that can give beyond themselves. This is what we call our progress pyramid. And these things here, so mission, values, vision, behavior, strategy, and structure, most investors don't think about, and they are the foundation of a business. They are the core ability of that business to actually drive a differentiated outcome. And so we say that you've got to get the person right and you've got to get the business right in order for this thing to compound. This is what we give to people so they understand our business. But I think that often analysts start up here. You see, financials are here, right? So if you look at that, that's the seventh element. There are 12, and that's the seventh. But as Jeff Bezos would say, he would say, focus on inputs, not outputs. And so this is an output, right? So this is the way we think. You want to build a building, you've got to build from the bottom up. And so succession's the last piece: growth, brand, digital, risk, digital, etc. So that's the way we think. And the reason I show you that is that in our business, there's been a lot of thinking, where if you don't get the ideas right, it's ideas lead to actions, actions lead to habits, and habits are your future. And so they're the big ideas that we've thought about.
I see. This is a very good advice to the young investors, that we tend to overanalyze the financial metrics instead of looking the values of a company. So I think
Yeah.
that
So
it's
we
a
say,
very
so
interesting lesson.
yeah, like we think like this. The mission of the business is to help private business owners be better off. And better off means healthier, wealthier, and wiser. The reason that that matters is because private business owners employ 70% of all people in Spain, in the UK, in the US, in Australia. So they are the heart of the economic engine. And because we have a heart for them, that gives us energy. So then we say, what values? We want people that are people for others, that keep their promises and play as part of a team.
I
Then we
see.
say, what's the vision? We want to build Australia's global accounting firm. Then we say, what's our strategy? Objective, scope, and advantage. What is the objective of the business? To double every 3 years continually. What's the scope? Accounting, tax, wealth, and estate in Australia, the US, and ultimately the UK, fundamentally globally eventually. And what's our advantage is we have a business system. We have a 5149 partner owner driver structure. We have a central management team that can actually deliver those results. And we've got obviously a huge 80 plus transaction record. So that's clarity of strategy. And then our structures, our 5149, our whole co at the head co, and our 5149 at the opco. Now, if you meet a CEO and they can't explain their business in that depth across the parts of the business, they probably, are quite good at what they do, but I don't think they're giving themselves the best chance to be great at what they do. And so I don't think that the business can outperform the leadership.
Amazing answer, Brett, of course. And for example, there are metrics or concepts that, as an analyst, I'm going to analyze, to further analyze. For example, what is your general idea of, for example, a company that has a high or a low skin in the game, or a successful or an unsuccessful business model, or an interesting M&A philosophy, or they have not really human values. These are concepts that you are worried on your day-to-day business.
Yeah, like I think that, so firstly, there are two types of people leading these businesses. So you're either an owner or you're a promoter. Now, an owner owns a lot of the stock. They're typically a founder that owns a lot of the stock. Now, Bain and Company's research on founders in the book called The Founder's Mentality, which is a ridiculously good book, very, very good book, demonstrates that founder-led businesses in the US market have returned 9 times the return of non-founder-led businesses over the last 30 years. So you do want a founder rather than a promoter. A promoter only has equity that someone gave them through an option scheme. They never put up any of their blood, sweat, and tears or their financial capital to acquire their equity interest. That, to me, is going to be very determinative of capital allocation decisions, because when it's your equity, you don't like diluting it. When it's equity someone else gave you that you can always get some more later through a management scheme, then you don't really pay attention to that. And dilution is critical. If you meet a CEO, you should ask them as your first question as an investor, how many shares do you have on issue? It's much more important than their profitability, than the ROE, than the ROIC, or any other measure, because it will tell you everything about their capital allocation discipline. Oh, how many shares do you have on issue? I don't know. How many did you have last year? I'm not sure. If that's the answer, you should probably find a different company. So
what should be the incentive, for example, for a chairman or a CEO from a compounder?
So I don't think that people like me are moved by incentives. We're not driven by, I want to be driven by an inner scorecard, not an outer scorecard. You don't do what I did. I had 65 personal guarantees before the company listed. I started the company with $200,000 of fees, and I took on debt of probably 5 million in the first 5 minutes to grow the business. So I left my job. I started a business in a small room with 4 people. I took an enormous amount of risk, but it wasn't risky to me because I was in my circle of competence and I knew what I was doing. So, it was a pretty much asymmetric bet from my perspective. And so then the question is, well, you do need to pay, part of the mistake that people do make is they look at people like me and they say, hey, Brett, you own 48% of the company. So, if the share price goes up, you benefit. And it's like, yeah, that might be true. But there's personal exertion and there's a return on your capital. I'm a shareholder like you or anyone else. So that's my return on capital. And then if I'm working in the business, I should get paid appropriately. I said to a shareholder, if you can create the types of returns that we've delivered, we've compounded the share price at 20+%, TSRs over 20% for 7 years in a row. If that was an investment fund, I would be pretty well paid and we'd have a lot of capital in the fund. So look, remuneration is very, very difficult. But I think that you can tell by, a very quick analysis whether that leader puts themselves before the business or they put the business before themselves. I think we've got a strong track record of putting the business first. I don't like options because I feel like that's an option on the upside with no exposure to the downside. So I don't think that's fair. I think that's disgusting.
Absolutely true. Absolutely true. I see your points. Yeah. And finally, to conclude this chapter, what should be considered, or what do you think about right capital allocation of a compounder? What should be the right mix on that?
Yeah, I think that good capital allocation is like driving a Formula One car on the Monaco racetrack. And it's not driving a sort of truck across, what's the Nullarbor Plain in Australia, which is one of the longest straight roads in the world, right? It goes from one side of Australia to the other. So you need to be very nimble when you're driving a Formula One around, Monaco. You need to be very nimble. Today it might make sense to pay a dividend. Tomorrow it might make no sense to pay a dividend. Today it might make sense to raise some equity and some debt to buy a business. I always reflect on Bernard Arnault, who I think is one of the best capital allocators in the world. When he bought the company that owned Dior, it had, I think, 3,000 entities in it. And I think he contributed about $20 million. And I think Lazard put up about 80 million of debt. So it was if you looked at it, you were like, well, hang on, that's pretty risky. But he was so confident that he knew what he was doing that what looks risky from the outside is not risky from the inside. Now, later, if you look through the story of the building of LVMH, he's paid dividends, not paid dividends, he's raised debt, he's raised equity. He's very much been more like a Formula One driver than a truck driver. If you compare, if you look at Warren Buffett, often people look at Warren Buffett today, he's 94 years old and looks like a friendly grandfather. But if you go all the way back and you look at the deals that he was doing with Charlie Munger of Blue Steel stamps and these types of deals, they were incredibly complex and they were sharp and energetic. So building that initial capital was very different to what he does today. So there's not a simple answer, but you should be guided by what is your actual hurdle rate. Mark Leonard's got this great line that hurdle rates are magnetic, in that if you drop your hurdle rate, everyone sort of drops. If you move your energy up, everyone moves their energy up. So I think the hurdle rate, the discipline around hurdle rate, while I think your allocation might change, I don't think your hurdle rate should change. And so, as an example at the moment in the US, for us to grow in the US as an Australian company is very complex from a financing point of view, because the US trading banks don't really want to lend to you. They've got a small business loan structure, which will give you about 5 million of debt. but they really don't want to deal with you until you've got about 20 million of revenue. So there's this sort of valley between 5 million of debt, say 20 million of revenue, which might be say 10 million of debt, which is this, these funny little, if you think about climbing a mountain, another little base camp. So, I think growing a business is complex. I think unlike the Formula One Grand Prix, the actual track keeps changing. So you've got to stay aware to the weather and what's going on. But the fundamentals of a high hurdle rate and a massive margin of safety, I think is what protects you over time. So that's, we're anti-dilution, we're anti-options, we're pro a high hurdle rate, and we're pro a massive, margin of safety. If you get that combination right, you can
sounds very good. Sounds the comparison was very, very to the point. I think that's quite clear.
Probably easier to say, right, than to do it, but
yeah. But interestingly, Capi, if you think about, anything done very, very well is very, very hard.
Yeah, that's true.
I came here January 23. It's been extremely difficult to establish the business here. But every time I came up against a hurdle, starting in Australia or here, I said, you know what? Only the mad people win, because no one else would put up with this shit, right? So I just keep, every time I get over a fence, I'm like, well, that's another hurdle, barrier to entry. No one else would climb that fence and get over that fence and do the next thing. So, it is easier said than done, but it just depends how determined you are. If you're not determined,
I like that sentence. Only the mad win.
Yeah, and that's Steve Jobs said. He said, most people fail because they give up, and they could be one step from success, but they give up. And he said, in order to keep going, you basically have to be certifiably mad. Right. It doesn't, it's very hard to build a world-class career, to be a world-class soccer player. If you look at Cristiano Ronaldo or Lionel Messi or Usain Bolt or Michael Jordan or anyone that's built anything, if you read Walt Disney's biography, his life was extraordinarily difficult. Really right until the end. He battling to build the business, to get the finance, to do this, but he put in big rocks that he knew would compound forever, and they have. He died, I think, in 1975. So I think that people think that things should be easy when in fact they are difficult. And if you just accept that they're difficult, then you're miles in front, because most people think, when you build a good business, everything will get easy. It's like, I've read hundreds of books. I never read that in any book.
Right. Okay, so moving into the last part of the interview, we will focus specifically on Kelly Partners, okay, on the company that you built, that you started, and you are running at this point. So for the people that do not know the company, tell us briefly about what is the business model of Kelly Partners.
Okay. The number one asset that you could buy in the whole world would be the taxing power of your government. So you're in Spain. You don't want to buy the airport. You want to buy the power that the government has to render taxes. That's the number one insight that I had. If you can raise the taxes, you can pay the army. If you pay the army, then you are in control. So you don't want the army, you want the taxing power.
Well, in Spain, we don't pay the army, they pay the media, just to stay in control, but more or less it's the same.
So the most important thing, so you would think that, but the person who pays the army is in charge. Now, recently, Vladimir Putin failed to pay the Wagner group, and they stopped marching towards Ukraine, and they turned around and started marching towards Moscow. He paid them, and they kept marching the right way. Yep. So the taxing power is the most important thing. Now, in all developed countries, the political class on the left and the right get paid from taxes, and they love to get a pay rise, so they just keep putting up taxes. So it's very simple that in the if you think about, you want to be in a business that's got wind behind it. I know that both on the left and the right of politics in every developed country, those politicians want to increase taxes. They don't want to reduce taxes. Even if they say they want to reduce taxes. Since World War II, nowhere in the world has taxes gone down except when Trump was president in the US and he did a big tax cut. But that hasn't happened in any other country since World War II in the developed world. So we know that that's a big situation. We know the multinational companies don't have to pay tax. We know that poor people don't pay tax. So the people that run private businesses have to pay all the tax. So for us, that's where we have expertise and passion for those people who are getting squeezed by the government. So that's where I put the business. We just look after those people, not multinationals and not poor people, because there's nothing to count for them. So if you get into that market position and you don't do anything else, we don't go off and do this, we don't get distracted, we stay unbelievably focused with the core group of people that we're trying to look after, then we developed a unique way to help those people, and we put a unique way to put the businesses together. We have a holding company, we buy 51% interest in an accounting firm. That reduces the succession issue by 50% or 51%, halves the problem. And then we double their profit, reduce their working capital by 2/3, and give the partners 25% of their time back. So it's a much better, much stronger business. They pay 9% of their revenue for our services team, 2.5% for IP, 6.5% for services team. And now that's over 10 million a year being invested under these businesses. So we lift up the business, take the pressure off the partners, give them a better lifestyle and a better offer for their clients so they can feel good about themselves. The businesses are much, much, much stronger in that format. There's no side-by-side financial risk because they're all special purpose vehicles. We do them one at a time. It's a small business, no big lending, and off we go. So the return on equity will be 30% plus. Return on invested capital, I expect, will be 25% plus. And the cash flow is 100% cash conversion. The margins are over 32.5% EBITDA margins. That margin's 2 or 3 times what the average firm is making. And we believe that we can do that 1,000 times in the same way that Constellation has done in the VMS market. Now, it will take 25 more years probably to probably 50 to 100 more years. We can just keep doing it. But in my mind, we're trying to build Australia's global accounting firm. There's 12 markets where Australians are present the most, the biggest places by number of people that they live. We recently bought a global network called Kudos, 51% of that. They have 60 firms in 45 countries. We're going to rebrand that ultimately to Kelly Partners Global. And then we'll have exposure in 45 countries. And then we think many of those firms ultimately may want to join our group and help other firms in those regions grow our group. So that's the vision. The methodology, the strategy is very clear, the structure is very clear, the vision is very clear. Our mission and values are clear. So if you go from the bottom up, we've got a clear mission, clear values, clear strategy, clear structure. It's not very complicated.
So what is the secret sauce of the success? So what makes Kelly Partners different, or why nobody's replicating what you are doing if it's that successful?
Because it's very hard. It's just easier to be a promoter than an owner. So there's private equity firms buying things. The closest firm to what we do is a firm called ETL in Germany, and they have over 1,250 firms. It's privately held. It's been running for 50 years. They do 50/50s. Their EBITDA margin somewhere between 10 and 15%, so much lower than ours. To do what we're doing is to form a partnership, a partner, owner, driver. Whereas what private equity do is they'll do a transaction where they'll just buy 100% and do a roll up and then sell it to someone else. Right. So it's hard to be long-term in a short-term world. It's hard to be people-centered and relationship-centered rather than transactional. But in the long run, I believe, like Warren Buffett believed, is that the compounding that you can get over 50% over 50 years is going to add up to a lot more personally in terms of the value of the relationships and the value of the life experience, plus the financial return, than doing a sort of transactional, messy roll-up. And you've got to ultimately be proud of what you're building. It's got to make a difference.
And why do you think that the partnership model is better than the other models? What makes partnerships really better? Yeah.
Well, if you think about a marriage is better than a different girlfriend every year for 20 years. You know, you might think it's fun to have a different girlfriend every year for 20 years. But ultimately, I don't think that you'll get the compounding of a family and children and relationships and a life, and their children and grandchildren. And, you know, so one is fun. You know, sex sells. Sex is funny and fun. That's that. 20 girlfriends, one girlfriend. Leonardo DiCaprio, an 18-year-old every 2 years for 20 years. I don't think there's any great compounding in that behavior. Whereas I believe if you get married and you have some kids and you build a family, that's a partnership. And I believe that's the most valuable thing in the world. So if you come to business, you have to decide, you know, do you want to build partnerships or do you want to be Leonardo DiCaprio? I think he's probably had a lot of fun, but I think ultimately in the long term, he will miss out on the compounding that a different set of behaviors can deliver.
Okay, well, that's an interesting way of looking into that. So tell us.
Different, like Capi, what makes us different is we think first about the person, right? I don't think first about the spreadsheet. I think first about the person. So I say, you know, what is the best way that you could treat a person so that you could treat them with the most amount of dignity and unlock the most of their human potential. Now, I believe that if you treat people with the most dignity and unlock the most of their potential, then that will deliver much more of everything than a different approach. So we build a structure that's human-centered, that respects that it's a 51-49 partnership. And I have said to the partners, they sign 10-year agreements. And I've said that if you work with me for 10 years, you'll probably want to work with me for another 20 years because it will be so good for you and your life and your business and your family. So It's really about what can you do in the long term versus what can you do in the short term. I learned this idea from Warren Buffett. He said, well, look out 20 years when you think about a business. Don't look out 2 years. So I'm just saying, what can we do together over the next 20 years rather than what's the next trade I can make? It's a very different way of thinking, but I think that when I look behind the great entrepreneurs who've built really amazing things, you can't build a great business in 2 years. It takes 20 years. Like if you look at Amazon, Walmart, Tesla, Facebook, whatever business you want to name, McDonald's, Four Seasons, Ritz-Carlton, Disney, that none of those businesses became the full flourishing of what they could be in 2 years. It took 20, 40, 60 years. But most people today, they think they can, you know, do it like this. Even the best tech companies in the world, like NVIDIA is over 20 years old, right? None of these things are overnight successes. It takes a lot of effort. And that effort is normally done. No one talks to you. You're in your room by yourself with a few really loyal believers, and you're just building. And it takes, you know, our firm is 18 years old in June. You know, when I was building this for the first 10 years with our most committed, loyal people, everyone would spit in my face. When I listed the company, we did our pre-IPO meetings with investors. They literally just spat in my face. They were like, what are you talking about? This can't work. This is crazy. You're ridiculous. What are you thinking? And I was like, well, hang on, let me try and explain it to you. But because people don't read, they don't really study, even if they read, when you would say, well, if you look at what Bernard Arnault's built or Osbrokers in Australia and insurance companies built, but you look at this company, they were small ones and then they grew. So here in America, there's a company called CBIZ, C-B-I-Z. They're a listed accounting group, the only listed accounting group in America. 10 years ago, their market cap was 300 million. And today their market cap is 3.5 billion. When I started in Australia, there was a listed accounting group that was 200 million of revenue. And I said they were making 10%. CBIZ was doing about 13% EBITDA. These guys were doing 10% EBITDA. And I said, I reckon we can get to basically 30 million revenue and have their EBITDA of 10 million that they were doing of 200 million. And so now when I came to America, I said, right, I think we can do 300 to 3.5 billion, but we'll do 3 times the EBITDA, which means they're doing $1 billion of revenue. We only have to do 300 million. So our challenge is to go from a run rate of 120 million to 300 million, which I think we can do. And our market cap will go from 300 million to 3 billion. So, but it will take another 10 years. That's okay. God willing, touch wood, if I can stay healthy, then maybe I get to do that for 10 years, which would be a great privilege. And in all of those numbers, that's just the compounding of human relationships and of behavior. I'm having fun. I go to Barcelona. I go to the McDonald's Global Conference with a bunch of our McDonald's clients. We had such a wonderful time. Like every day we're in that amazing, what's that place you have lunch down in that big Victoria, or where there's all those restaurants.
El mercado ¿no?
La boquería. Which market?
Yeah.
Well, I don't know.
There's this great restaurant,
which
right? So every day we go, they cook the meat, chop it up, we eat the meat. We were sitting with clients every day. Beautiful lunch. We do the conference, have a beautiful lunch, have a beautiful dinner. We come and we meet with you guys and speak to your colleagues who are investment managers, great people. None of that was work to me. None of that was painful. That was all great fun. And so as we keep doing what we're doing, we build more good relationships. We help more people. So we help more people, which builds good relationships. And there's a compounding flywheel of good outcomes. And the money follows. So it's no big problem.
Perfect. So moving into something slightly different, but I think related, tell us a little bit about the values of Kelly Partners. What are the values that are driving the company, basically?
Yeah, so people for others. Firstly, the business has to be a social service organization that makes other people better off. The second thing is we have to be people that keep our promises. So if we say we'll do something, we must do it. And the third thing is we have to be convinced that a team can do more than an individual. So team-based, not individualistic. And then right from the beginning, we said we had to be a profit leader, that we're a capitalist organization. We're not a socialist organization. We're not a not-for-profit organization. We believe that businesses that make a profit and reinvest are very good for society. So, that's the approach. We want to modernize accounting firms to make them better places for people to work, that deliver better outcomes for clients, so that those clients can run their businesses better for society. So that's kind of our mindset. And that's worked out really well.
Perfect. So Gerard, your turn.
Yes. Regarding the M&A strategy, could you give some light if there is any difference between an M&A process in US or in Australia?
Yeah, the M&A process is the same. We've had a very developed and very detailed process. We have always said that you should do the due diligence on $1 million business as if it was $1 billion business. Because if you do enough $1 million deals properly, well, then they'll add up pretty well. So it's a very detailed process of examining the motivations of the owner and the behavior and values of the owner, or values and behavior, why they want to join us, and are they capable of an effective partnership. So that's the key piece. Then we do all of the financial and legal due diligence. It's a very developed process that we've run now in over 80 of these transactions. So we don't miss on due diligence, and we take plenty of time and effort to do it.
Yeah. And another question about due diligence. Could you explain a little bit further because there are some due diligence that last 1 week and another processes that may last, 2 years. Could you give some light on
Yeah, so
on
to
this?
give you an example, the first deal we did in Los Angeles, I met the gentleman in January 2023. He came to Australia in February 2023 to meet our people. And then I took him to Omaha in April, traveled with him for 4 days. And then that deal was signed in December. So I spent a lot of time meeting Mike and deciding that he was the right guy. I took him to Australia more than once, I believe, and traveled with him to Omaha, spent time. I got a number of our investors to meet him as well, and I reviewed the firm. Now, I can typically do that process in a week. I can also do it in a year. The longest time it's taken me to buy a firm was 14 years, where I met the gentleman and I made an offer, and it just took a long time. Didn't really matter because we're always talking to other firms. So it's really a little bit dependent on who the person is. And, you know, you have to trust your instincts as much as anything, and you have to develop your instincts so that you can feel. You know, people discount how they feel too often. If something makes you feel sick, you should probably think it's poison and not do that. So, yeah, it's a combination of the rigor and diligence of what's objectively observable, and then it's the inside of emotion and intuition.
I see. And regarding the first half 2024 results, could you give some color behind the acquisition in India?
Which one, Jared?
In India.
In India, we started an office in Mumbai, fully branded. We've got about 36 people there now. We're trying to teach our partner group and managers how to work cross-border. We think the future's a global workforce. If a young person says, you know, I want to move to Spain, we want to be able to say, no worries, just take your computer and keep working for Kelly Partners. And so India is part of that. We've had our office in Hong Kong for 9 years. And so it's always been our intention to build a global business. And so we're just doing it incrementally, step at a time. There was no cash outlay. There was a small amount for a bond for an office. And then we started recruiting. We put people in there. Our managers are training them. There's a little bit of capital cost to travel there and meet the people. But most of this is about building muscle, you know, is putting the ability into the teams to do global business.
We follow very closely India in our channel. So for a company named Nagarro, this is an IT service company. So, well, the other question is just the divestments from Kelly Partners. As could we read on the report, there were several companies that they were partly underperforming, not aligned with the mission, values, and strategy from Kelly Partners, and not from the circle of competence. What are the learnings of these divestments? There is any potential threat for another business unit?
No, our mindset is simple. We believe in experimenting. So first bullets and then cannonballs. That's straight Jim Collins. And so in the wealth management space, we had a business approach us that also had an accounting firm. And we wanted to take that accounting firm and merge it into one of our accounting firms. But they had a wealth management business in the retail space. So there's wholesale, which is above 2.5 million, and retail below 2.5 million. We thought it was a good business, and so we were prepared to bring it into the group. It turned out to be a very poorly performing business, and we were offered a very high price to sell it. And so we said, you can have it. So we sold that business. Unlike Warren Buffett, who has never sold a business, we, you know, if we believe we've made a mistake, or we think that, you know, we took the accounting piece of that, which has worked out really well, then if we make a mistake, I would rather admit the mistake, especially when I get offered a high price, and just take the gain and sell the business, and you know, get rid of the noise. For us, Jared, we don't have a big management team. We can't afford to do a turnaround. I don't want to spend my time doing that. So if a business doesn't meet our values and behaviors in any way, we will sell it or close it or merge it. So in the last 12 months, we basically did a review. We had 8 businesses that we thought were okay. There are 2 lessons. One, if they're just to the side of your circle of competence, take the accounting group but sell the rest, which when that vendor came to us, they weren't prepared to sell us the accounting without the rest. So we took it all, we cleaned it up, we kept the accounting, we sold the rest. The other one is that when we bought small businesses, so businesses with 1 million of revenue or less are too small, and our ideal has been 2 million, 2 partners or bigger. We're getting much more disciplined now about saying, if you're not the right size, unless you're a tuck-in, we're not going to do the deal. So we had 3 businesses that were standalone businesses under 2 million, and we've merged them into larger businesses in their regions. So that's about getting more focused and admitting that we've got 18 years experience now. So that's enough time to experiment and say, this works, that doesn't work, we won't do this anymore, we'll only do this. So I'm pleased that's, we haven't lost $1 of capital in that exercise. So that's fine. And it will create more time. I think we're getting more aggressively focused around admitting where our best opportunities are. The way I'm thinking about it is we need to make a journey from cigar butts to compounders. And when I started, I was prepared to buy a cigar butt and fix it and keep it and turn it into a whole new cigar. Now, I'm like, we're getting approached by such high quality businesses that I'm saying the pipeline has changed, the funnel from cigar butts to compounders. If it's a cigar butt, I'm not going to do the deal unless I can add it to one of our compounders. So that's often regionally based. If we're not, let's say we have no office in Barcelona and a $2 million firm approaches us, or say a $1 million firm, we would say no. If a $2 to $5 million firm approached us, we would probably say, yeah, we'll probably do that. If a $10 million firm approached us, I'll fly there tomorrow. So that's kind of, now we don't want to do endlessly larger deals. Our target is 2 to 10 million of revenue. So if a firm rang me that was 25 million, I would say you're too big. But if you're in that sort of 5 to 10, I'd be happy to do a new location. So we're getting more refined and disciplined about where we put our time. I think at the moment we have 190 plus firms in our funnel. So we don't have to say, oh, what are we going to do? I have a little pile just here. These are just all deals I'm working on. So I'm like, I've got enough in my pile. What we're trying to do is I'm trying to combine the extreme selectivity of Buffett with a programmatic mindset. So I want to be a programmatic acquirer, but I don't want to lose the extreme selectiveness that Buffett had, and that because that's how I built the group. I was like, no, that's not good. I'm not doing that deal. The terms aren't right. I won't do it. This doesn't work. I'm not doing it. So we're very, very selective around price, terms, hurdle rates, quality of the people. That's the Buffett piece. And then here is the programmatic piece. So a lot of people say to me, are you going to do more deals next year than last year? I go, I don't think about doing deals. I just think about doing good deals.
Right.
And I think about how many. I'm happy to do one deal like Buffett that's great. And if I can't find 2 this year that are great, I won't do anything. That's how we built the business. So our growth, you'll see, sort of does this. So it grows, plateau, grows. It doesn't just go. And so,
Okay.
It makes sense.
I
It
guess
makes
that
sense.
aligned with what you said, the next question is about capital allocation, right? Because you are right now in US, and you expect that will be an important market, let's say, in 20 years. So for sure there will be spend there will be acquisitions. So in terms of capital allocation, and you gave us that example that I think is quite good about the F1 car in Monaco. So where are you now? In which turn of Monaco, basically?
yeah. So we, the Grand Prix starts, they have a pacing car and you run around and you get your tires warm. Well, we've got the tires warm and we're in the, the early laps of just making sure that we know how to drive this course. I admit, we think that humility is the beginning of wisdom. And so the thing that can hurt you the most is hubris. And so we have to admit that I've never driven an F1 car on the Monaco racetrack. So I've turned up, I'm driving around, it's warm-up days, I'm just warming up my tires, trying to get some heat in the tires, and I'm doing my first laps going, hey, hang on, woo, and being very careful. I'm driving at 50% of the speed that we can drive in Australia. I'm just driving slow, they're honking me, too slow, that's okay. I don't really mind because, if it rains, I don't know what I'm going to do if I can't see. So I'm very risk averse by nature. I call it being aggressively risk averse in that small circle of competence. It's a new racetrack. We're being extremely careful. For example, the first 2 deals we did, we paid cash. We didn't borrow any debt. And the reason is I don't know the businesses well enough to want to take a big risk. Now, the good news is there are elements of the market here that we do know well because we service the same clients in Australia. And I won't share what that is, but you know that I was in Barcelona with the McDonald's conference, and there's 14,000 McDonald's restaurants in America.
Yeah.
So we do about 12% of the restaurants in Australia. I think we can probably do a little bit of that business here. So that business is a business we know. Whereas a lot of other things, we don't have any claimed, special knowledge. So, we think you should be careful. There's an amazing Australian group called Westfield, and Westfield became the largest shopping center group in the world.
Yeah, I know them. We have in Spain, I think, and for sure in London. Yeah.
Yep. And so that's an Australian business. I'd encourage your listeners to look up Frank Lowy, Lowy, his biography. It tells the story of building that business. He grew it from one sandwich shop in outer Western Sydney to the biggest shopping center group in the world and sold it for $35 billion US dollars to a French group. Now, they came to the US in like 1985, and it was a big group at that point in Australia, and they just bought a $6.5 million shopping center, I think, in Connecticut. And it took another 25 years to build, the biggest shopping center group in America. So I have them as a North Star as to how to grow globally. And they did it very patiently over 50, 60 years. So, we're not doing anything that we haven't studied that has been done before. We're just being very, very careful about how to do it. So early stages, we're not even on race day in Monaco. We're in the warm-up days. We're just testing the car. We're warming up the tires. We're just working out what we're doing. We're pretty patient, guys. Much more patient than people realize. But that goes to be owner, not a promoter. I'm not looking to sell the business and retire tomorrow.
Right. And going back to Warren Buffett, because you spoke a lot about him, but one of the things that he says is about the ability to fix prices and to increase prices, right, when there is inflation. So how would you describe the ability from Kelly Partners to do it, to increase prices?
Yeah, I'm pretty excited about that, Capi. So our organic growth, if you look at the organic growth in our results over the last 5 years, probably 6%. Inflation wasn't 6% all of that time, but if we just step back, over the last 10 years, 50% less people have studied accounting at university. And of those people, 50% less have gone into public accounting. So there's a severe contraction of talent. And what that means is that as a firm, we can allocate our talent much more judiciously. And so we can simply just put our prices up, because if a client doesn't want to pay that price, they would have to go somewhere else, because we have this much work and this many people. So I think that there's going to be a lot of pricing power come to our firm and our industry over the next 5 years. I don't think anyone was expecting that. Most people are saying that AI will get rid of our industry, which is totally wrong. And so I think you'll see a lot of pricing power. It's pretty exciting, actually. Like we're in America, probably the biggest thing I've learned here is how aggressively firms raise prices, whereas in Australia we're much more nervous to do that. But we we shouldn't be, because we're very good at what we do, and frankly, there's not a lot of other options for clients.
Right. Okay, Gerard, you can go.
Yes, just two more questions, no more, Brett. Thank you. The following question is regarding the return on invested capital, which is circa 20%, while the discount rate of the group is about 8%. So, do you consider that is sustainable over the time?
Yeah, I think it's not only sustainable, I think we can get better at what we're doing. So I think we can get higher returns over time. We have learned so much about what we're doing. We're still relatively, we still consider ourselves enthusiastic amateurs. We don't, and that's because we compare ourselves to, Warren Buffett or Bernard Arnault or Mark Leonard. So if you look at the best in the world, we consider ourselves students, and we think we can continue to improve, and probably quite dramatically. So, I wouldn't bother to do any more business at low returns. There's no point. It's a waste of time.
No, of course, it's giving, it's aggregating a lot of value to Kelly Partners, this one, so it's brilliant. 100% agree. Well, and the last question is about the owner's manual from Kelly Partners. That there is a slide showing the issued shares from Kelly Partners. This is quite impressive because compared with other companies, Kelly Partners has not issued shares across the years. So, what is your understanding about dilution and raising capital?
So we shouldn't issue shares unless we get a lot more value than the future value of those shares. Now, we believe that today the business is dramatically undervalued versus its intrinsic value. If you do a two-stage dividend discount model, which is our preferred model, and say the business will grow at 20% a year for the next 10 years, and then say 2.5 or 5% terminal value, then the company's immeasurably more valuable than it's trading at today. And so raising equity at a large discount to intrinsic value, which is essentially what you're doing when you're issuing shares, is not only dilutive to your existing position, but destructive to your future position, because the maths just don't work. And so for us, we're trying to close the value of the market cap closer to intrinsic value. We intend to move our listing from the ASX to the New York Stock Exchange, raise some capital. We've raised 13 million Australian dollars since inception, which is about $7 million US, $7 or $8 million US. And so we've created the listed vehicles worth about 320 million Australian dollars. So we've got a 25-time return on that money. We've compounded it 20+% a year since IPO. I've compounded my own capital at 60% a year, or 50+% a year for 18 years. And the other half of the business isn't listed, so let's assume it's worth the same as the half that is listed. We've raised 13 million Australian dollars and created 600 million of value. So we're acutely aware of how valuable each share is, and we treat them like a Picasso or a Miro. If Picasso comes alive tomorrow and he paints another 1,000 masterpieces, it doesn't make the value of your masterpiece go up. It makes the value of your masterpiece go down. And so when somebody says to me, the liquidity is low in the stock, why don't you issue some more shares? I go, if, Rembrandt, I think painted, there's 36 Rembrandts in the whole world. If 36 or 65, a very small number, if Rembrandt came back to life tomorrow and he painted another 65, that wouldn't make the value of your Rembrandt go up. So, we think that I think we started with about 45,800,000 shares. We've got 45 million shares on issue, round number. We don't want to aimlessly issue stock. unless we're getting a lot more. But we've got to get a lot more than we're paying for if we were to issue stock, and I don't know how we would do that. So we're a little bit, we lack a little bit of capital flexibility at the moment because of the discount to intrinsic value. So we can't really raise equity at this price. We're definitely not going to issue shares for an acquisition. So we'll continue. I sort of think about us bootstrapping the business. That's kind of what we're still doing. We're using the internal cash flows of the business to acquire further businesses. We pay them off aggressively. You'll see that we're paying off over 10 million a year of principal. And we're basically just recycling a $50 million facility and generating more and more return. There will be a point, Gerard, where we've run a calculation that shows if we were to raise money at intrinsic value minus maybe 10%, and we could invest that, the proceeds. If we raised $50 million and we could borrow $100 million against the $50 million, that would give us a further $150 million, which would mean we'd be able to buy half of $300 million of revenues. If you do that spreadsheet, we can get about a 22% return on invested capital. And so the value of the group would dramatically increase. And so, if we could raise capital closer to intrinsic value, then it would make an enormous amount of sense if we could invest that capital at a 22 to 25% ROIC. I think we can ultimately push that ROIC quite a lot higher than it is today. And so, we're just in that little period where we're trying to get a little bit of size here in the US, prove up that we know what we're doing, get a US listing, and then we've got a posture, like essentially a Berkshire, that is US listed, biggest capital market in the world with a global, addressable market. That gives us then 25-year period. I work in 25-year period, so I'll be 50 in August. So then I've got a 25-year plan from there. If I could compound it, 20% plus for 25 years, then the number's pretty significant. If we can compound in that way, and we can make the type of impact on the industry and on people's lives and the families' positions that excites us. So that's the way we think about it. You can tell.
Very interesting. Very interesting. Yes. Absolutely amazing.
We do think about it. We actually really think about it. I think most people don't think about it. You can tell. Hopefully, you can tell that we spend a lot of time thinking about it. We've modeled it. We worked with our bankers to really model it. We've had to really, share. We've had to kind of take our bankers on that journey so that they could see the numbers and really understand. I'll give you a funny story to end with, guys. 12 months ago when I came here, I went to our biggest shareholders and said I wanted to raise some money at a 30% premium to where the share price was that day. And I think at that point the share price was about $3.40. So we offered them the opportunity to invest somewhere between 20 and 50 million in the equity. This was on a wholesale private basis at about a 30% premium to $3.40. So maybe at about, what's that, $5 or something. And they were like, oh, well, we're not sure what you're doing in America. We'd like to see you get a bit bigger there, and one that's more developed maybe, or we don't have any money at the moment, or we could just buy it on the market, which you can't. You can't buy any substantial position in the market. Yeah. So I just said, okay, well, we'll just keep doing what we do. And so today, if we made the same offer, it would cost them $11 a share. I think when you sit and chat with me about our business, you do need to accept that I've been working in the accounting industry for 31 years. I've written 4 massive books on wisdom. I've read about 3,000 books, built a group with 23,000 clients, and done a few other things. So you could probably accept that I know just a little bit about what we're doing. Yeah. And so, you might be better off if you agree with me a little bit occasionally.
Yeah, sometimes, right?
Not all the time, because I'm not right all the time. But when it comes to the depth of understanding of our business, I think I've spent a lot of time working on it and thinking about it. It's really all I do. I basically, my hobby is the business. I play golf about 4 times a year, and
That's
I go swimming. I work out. That's my number one hobby is working out, exercising. And my number 2 hobby is reading books. And
I have a question to finish. That I had this question at the beginning of the conversation, but I didn't have the chance. More or less, in the past 12 months, the past year, how many holidays did you take? How many days?
So, Capi, it's not the last 12 months isn't really been reflective of, say, the last 10 years. Over the last 10 years, I've typically taken 16 weeks holidays every year. Over the last 18 months since I've been here, I've gone back into startup phase where I don't take holidays.
Okay.
I'm about to take a 2-week holiday in July, which will be the first holiday I've taken since I came to America. And I've done 8 or 10 trips back to 10 trips back to Australia. I've traveled to Spain and Florida and Texas and New York and all over the world.
That was work.
Scotland and Sweden. I guess I would say that I don't experience, like when I went to Stockholm, I had so much fun. I can't think of anything I would have more fun doing. I watched 30 presentations of companies. I met lots of great investors.
Yeah.
What all we're doing was talking about serial acquisitions. That was amazing. So that was like a holiday. Then I went to see a firm in Scotland, and I took an extra day. I was very proud of myself. I took an extra day to have a holiday to go and see the Highlands, the Scottish Highlands, which I've always wanted to do. So that was incredible, day and a half. So I was proud of myself for doing that. But I went to see a firm in Scotland. I love that. I came to Barcelona. I did a conference, but I was with my clients, and I came to see you guys. That was a holiday. I went to the Berkshire meeting. That was a holiday. I went to New York. I had a holiday with the kids for a week last year, 10 days, and I did a lot of meetings. That was a holiday. So I'm very blessed.
Well, it sounds like you are on holiday almost every week, right?
No, look, I'm very blessed that I experience my work as fun. I absolutely love what I'm doing, so it's no problem. I do need to have an actual break in July, which will be great with the kids. It's been difficult for the kids to sort of change schools and understand the system. So we've had to do a lot of work to get that right, and they're very happy, which is good. And look, going forward, I'd like to get back to holidays. I would say the last 10 years, pre-coming to America, I had a lot of holidays. But when I'm on holidays with the family, they know that I get up very early and I work before everyone wakes up, and then I go out during the day with them. And I always have my phone, so if I need to do anything, I just go to the bathroom and work on my phone. So, I think I don't believe in work-life balance. I believe in, living a mission. And I think that if you're living a mission, then you should be very committed to that mission.
Right.
I think the whole work-life balance thing is just for people that haven't found their mission. So I would encourage people to not work on Sundays. But basically the rest of the time they should work on their mission, and your family like to be part of the mission. They don't feel bad about being part of a life with a mission. Frankly, if you don't have a mission, that's a pretty impoverished way to live, and not financially, but just spiritually.
I even work on Sundays because our key YouTube program that is like live is on Sundays. So even on Sundays I'm working. So you can consider yourself lucky compared to me.
I always had a rule. I wouldn't do any client work. I wouldn't work at all on Sunday, and that's been very good for your mental health. I do believe people need a break. I wouldn't encourage people to overwork.
Yeah.
But I wouldn't encourage people to have this, that's work and this is life, because they're two sides of the same coin. You want to have an integrated life.
Yeah.
Guys, I appreciate you making the time to talk about Kelly Partners today. I hope
thank you very much
I'm happy if you get questions from any of your listeners. I'm happy to answer those questions and send you some answers. and I'd be very happy to catch up again. I hope I get to come to Barcelona again soon.
Okay.
I
Just send me
enjoyed
an email, drop me an email, and we will do something funny.
Yeah, we can come to the business school and meet some people. I had such a great time. The beach was beautiful, people were wonderful, and the food was delicious.
It was really good. Okay, well, thank you, Brett, for your time, and we stay in
We
touch.
feel we feel very lucky to have you today, Brett. That's a
No
pleasure.
problem.
So thank you very much for your time, of course.
I appreciate it. And now that I live in California, I have to put on my list of goals to learn to speak Spanish. So
You need to
I
start.
love Spanish music, and I need to learn Spanish. So that'll be on my list of things to do. Have a great day, guys. Thank you.
Thank you. Bye.
Thank you.